It is a great pleasure to welcome to Best Ideas 2025 returning MOI Global instructor Frank Fischer, the CEO of Shareholder Value Management AG, where he also acts as the Chief Investment Officer. In addition, Frank is also a member of the management board of Shareholder Value Beteiligungen AG and chairman of the supervisory board of Intershop Communications. Frank was honored as Fund Manager of the Year in 2018 and is widely regarded as a foremost value investor. He's based in Frankfurt, Germany. From 2009 to 2014, Frank was also a member of the board of Pulsion Medical Systems, and until the end of 2005, he was the managing director of Standard & Poor's Fund Services, formerly Micropal, where he was responsible for investment fund information and ratings. And after going back further, after completing his apprenticeship as a banker at the Hessische Landesbank, he completed his studies in business administration at the University of Frankfurt. He is also the founder and director of the charitable foundation Starke Lunge. And Frank, I'm very grateful to you for joining us again this year because your presentations always add tremendous value to the MOI Global community. So thank you for taking the time. And now I will turn it to you. Please go ahead.
Thank you very much for the introduction. Yes, today I'd like to give you a view regarding what we see as a really interesting cultural change that coincides clearly with the top man at SCOR, one of the key reinsurers globally, who's actually driving that change. And very much as it is with asset management and reinsurance, you take risk and you allocate capital. So he's actually quite close to what we do when we think about asset management. And we would like to show you what we think is actually driving this change, and whether there's an opportunity in it for yourself, you can then think through after you've seen my presentation. But before I step into SCOR, I would like to briefly review last year's best idea, Sartorius steht im Biotech. Here we have to say that the COVID destocking has actually led to a further reduction, and actually a bit of a disappointment because we didn't get that right, neither did management. We thought that destocking would come to an end earlier. So since we are looking at really a wonderful business here in a space which is definitely going to grow double-digit in revenue, probably mid-teens in the biopharma, so we think this case isn't broken, but actually provides more value than it did before. However, there has to be a bit of a warning. There is a new CEO stepping in. There might be some kitchen sinking. Maybe even the midterm guidance is at risk in February. Whether that's priced in or not, we will find out. But we still believe that this is really a great business and that it's good to own it for the long term. Prior year, before steht im Biotech, SAP is still going strong and has delivered outstanding returns. So sometimes we also get it right. Now, clearly, we've progressed in our own journey, very much like Warren has. We started out with asset value being one of the key drivers. So, for example, in the stock club that we initially started in the 80s, we looked at companies which would have great property value, and that would be kind of hidden and would be really relevant in the valuation. We would look for a trigger. So a lot of the brewing companies, but we also had companies which were producing tiles. And that wasn't such a good idea in Germany with all the environmental protection related costs and the labor costs. And so when that turned into a property REIT, the value was then realized, and that would go up double or triple in value. And that was also good investing. But as Buffett also learned, mainly through Charlie, it's really better to buy a wonderful company and then start compounding. And even at a fair price, that is a good idea. Then always looking at fair companies at wonderful prices, because you really can't compound with them for the long run, but then you have to find the next one and you take additional risk. And with these wonderful companies, you learn over time and you can reapply that knowledge. So in this case, this is why time really is the enemy of the bad company. You just can't sit on it. Whereas the friend of the good company, because it does make sense to get into businesses which do something like 20 or 25% return on equity or capital, and just let that compound for the long run. And that's how we have also evolved. And we believe that we will be doing much better by actually going for these companies. But still, we think this is something which not everyone has really fully understood. But Charlie shared it with us. He said, really, I'll share the trick with you. It is really getting into better businesses. And when we looked at our own good ideas and the bad ones, which left a dent in our performance, we realized that actually with these wonderful businesses, we're doing better. And so we share that view. And we're very grateful for Charlie having shared that trick with us. And this is how we've actually then, probably in the mid-teens, so around 2016, 17, refocused our efforts to be predominantly looking at modern value, because we could also call it QARP, quality at a reasonable price, because we are not growth investors. We always look at the margin of safety. You should not forget that. But we actually differentiated between the Graham style and now label it modern value investing. And so this trick is something which we clearly have embraced now. So really the question is, what's the difference? Clearly, positive growth dynamic is very, very helpful so that you actually get at least mid-single digits. Business like Steden, which is actually giving you kind of mid-teens perspective, clearly is better, but usually you pay up for that. And you want to make sure that it's reasonably capital light so that you get really great returns on capital, because that's what compounding is all about. And ideally, you get incrementally better results with any redeployed cash. So, you know, returns on incremental invested capital being much higher than the prior, that's even better. Company that's incredible for that one is ASML. The monopoly is so good that their reinvestments generate 110 or more % of their reinvested capital. So clearly you don't want these guys to pay a dividend to you. You want them to reinvest that money. And what's very helpful is that you do have a moat. If there is anything like a moat that protects your castle, well, then clearly that's better. And it should actually last longer, because otherwise you just can't compound with that idea. And it is okay to use some level of debt, but we would rather have moderate levels of debt, because otherwise in crisis, the bank owns your business, and we actually want to be continuing owners even in times of crisis, because future is always uncertain. You never know what's ahead of you. We really like to look at the culture of businesses, and we typically find a culture of an owner or family managed business as something which can be better. It's not always the case, but in an ideal situation, it leads to reduced principal agent conflicts. And we know that in very much a changing world that we're in, looking at AI and lots of other opportunities, but also challenges ahead of us, it's really important to attract the right talent, because only that ensures the constant innovation. And if you have a right culture, then those people that you really need on your team to be performing well would like to join you. And this is why we believe that SCOR is actually very interesting to look at right now. Now, one thing which I already mentioned, never forget, don't lose money. You want to invest with a margin of safety. Even when you go into modern value, never forget that rule. It's great if you own that business, and yes, over time it will work out, but you don't want to be too early. When you look at Stedin, for example, we were too early, but the quality of the business will actually, over time, make it a reasonable investment still. But of course, the returns when you get in now will be much better. And the clear thing is to follow the advice, which is you pay your 60, or maybe for those modern value companies, the 70 cents on a dollar, because you don't get it at that depressed valuation, but you always act with a margin of safety. Now, when you really look at what drives investment results over different time horizons, then in the very near future, today, next week, this month, it really is the sentiment in the market, how you really feel about it. I mean, clearly we had a bit of a setback going into this year, and then sentiment turns negative, which is always good, because when it turns negative, then it can show the opportunity is there to get back into the market. So fear and greed are the very short-term drivers. And then you look at the change in multiple, which especially over a 1-year time frame can be very much rewarding or actually detrimental to your investment results, because if the mood changes for the medium term, well, then that contraction in multiple will work against you. And yes, we are at elevated multiples, especially in the US in the Magnificent Seven, and that could continue, but you know, the air up there is a bit thin, I think. So it's always good to think that this is not just a linear trend that can be extrapolated always into the future. So we kind of have changed, looking more at Europe instead of just being in the wonderful businesses that we clearly do find in the US, but maybe we can re-enter at a lower valuation. Then cycle and industry that you're in is really very relevant when you think about a 3 to 5 year time horizon. And ultimately, it is all about how to redeploy the cash. So can you really reinvest at great returns over the long run and then compound? And over the very long term, it's really people and culture that make all the difference, because otherwise, if you do not innovate and if you don't really build your moat, then someone will take you over, or you just exit doing what you are doing. So people and culture being, as a long-term investor, very important, means you have to look at management, and then management change can drive you into an investment that actually didn't look so great before. And here we go to the cultural change that we believe is happening. So we think that SCOR is going to be, it is already on the way to a wonderful company. In May 23, Thierry Léger started working at SCOR as the new CEO. He came from Swiss Re, and he was heading risk there. And when he left, the share price of Swiss Re dropped by 6%, roughly. So that's a good sign that there is a new manager coming that is considered to be good, and it's bad for the business that he leaves. Well, SCOR didn't rise the minute that was announced, because maybe people were realizing this guy has to do some bit of cleanup there. SCOR is actually, you know, probably other reinsurers in that industry, less well known, but actually it has 38 branches, has more than 3,000 employees, and it is one of the top 5 in the industry. It is not the biggest one, clearly, but when you look at the valuation going into this year, we feel it's quite attractive. So yes, we believe Munich Re and Hanover Re and even Swiss Re, they might be the better businesses, but the change will actually open up the opportunity, the cultural change of a multiple expansion as well over time, if our thesis holds true that Thierry Léger will actually drive that cultural change. And we already see that, and this is what I'd like to elaborate on in my presentation to you, that change is already well on the way, because this guy is very active. Not only did he change the investor relations side, but also the CFO very early on when he got into the new job. He realized, with these guys, I'm going to get nowhere, so I have to change. And that clearly continued. the head of the life segment was also replaced. And then he stepped up himself and said, you know what, until I have a successor, I'm going to run this myself. And so he takes on responsibility and drives that change and is absolutely relentless. He's got great energy and wonderful integrity. It's great to meet him. And so clearly, we also think that there is a helper here with IFRS 17 accounting, which will lead in the life and health segment to reduced earnings volatility. And so you've got change coming from various aspects. Another key element is that this business is actually in the reinsurance industry, the one with the shortest duration. So overall, even though we have now seen a bit of reduction in interest rates again, interest rates are back. And I know they are here to stay because we've got the 4 big Ds, starting with defense. Spending money there means there is more demand, which will have to be fueled by bonds issuance, which will drive up interest rates. The same is true for decarbonization. You will actually have to reinvest more in order to drive down CO2 production. And deglobalization, we see the tariffs being imposed most likely by Trump and others. We're also protecting ourselves in Europe against the flood of Chinese EV cars. That all is driving up costs and thus interest rates, and deglobalization and demographics are adding to that. So that means interest rates are here to stay, which means they can actually generate a net interest income, which actually in the last decade has been quite reduced and was lacking. So we're seeing another driver of increased earnings going forward. Now, when you look at the share price, including dividend, it actually hasn't gone anywhere. It's not dramatic, but it didn't really deliver great returns. And you also see in 24 a big drop. Where did that drop come from? Well, clearly, Thierry decided to have a look into all corners and whether he needed to do a bit of kitchen sinking. And yeah, he found some areas. Also, when you look at the history, you see that that was driven during the COVID crisis, that government said, you know what, paying out dividends now, I'm not so sure that's a good idea. And that led to a bit of a frustration on the investor side. When you look at the premium income per quarter, actually wasn't dented as much, so they could have continued, but clearly that was a political decision to actually stop that. And that was also one reason why there was earnings volatility. So in certain crises, that can happen again. But good news, we see that there is, over the long term, a growing trend in premium incomes, and we think that trend will continue in the future. Why is that so? We see that the reserve reviews, which were concluded and externally validated and communicated, and these are slides which I've just taken from the Capital Market Day that was actually done in mid-December. So you see that the review was actually completed, and in property and casual, all lines at best estimates and increased resilience, you see the check marks here. And you see also that WTW said, you know, they're actually supportive of the conclusions that SCOR themselves actually communicated, and they just confirmed that. Now, where we had an issue was life and health. And here, that very broad portfolio review led actually to a bit of a frustration because there had to be some reserves being built. Now, after that happened, that review led to the kitchen sinking we believe to be very much completed. And we think that we now are in a situation where going forward, there will be much more stability. That doesn't mean that there is not still something to be done in life and health. And also going forward, we believe that the focus on taking better risks is also something that as a risk manager, Thierry Léger will be relentlessly focusing on getting higher returns than they've had in the past, so that this will not happen again, that he has to kind of cushion bad judgments which happened in the past. Now, when you look at an enhanced earnings power, which we see also over the very medium term, we already are in 25 clearly, there is, when you look at the flat management expense of roughly 1.2 billion, that means there will be additional savings coming our way. And all those savings, they can share either via dividend or via buybacks, and they are clearly doing that and have that on the agenda. So we like that he's not just looking at what's actually in my portfolio and do I need to provide some reserves there? Can I actually also save money to drive earnings? And that's what he's doing. So he's actually, I mean, he's been not 2 years in the making, and he's actually now looked at all aspects. For example, there's an opportunity with the French deferred tax assets. So by repatriating profits to France, he ensures that they can fully benefit of exactly that DTA. And so if you do this, you actually have more cash generation in France and you realize those operating profits there. And that means the net income after tax for us will be better. And that's something which we really like as investors, clearly. And yeah, we are seeing that there is not a single angle that he actually leaves untouched. So when you have that opportunity, then it still requires you as a manager to focus on doing that. And I think without the change in management, we wouldn't probably even know about it. So this is what the cultural change opens up as an opportunity for us. Now, when you look at the future ready, and this is now going to be also working beyond 26, he's actually looking at how to use the capital, how to steer the capital allocation in a much more disciplined, this is also cultural change, disciplined cycle management. So this is really when you think about risk taking, you actually are looking at the Solvency II capital generation, and you're looking at the IFRS capital performance framework. And that is already now effective as the 1st of January in 25. And the main KPI, the Solvency II, will be refined in 25. And actually it will work by staying within the limits of forward 26 risk appetite in the future years. So the idea being lower capital intensity, generating higher capital returns. Now, the whole asset liability management, if you look into a more dynamic framework here, he doesn't just stop with the risk taking. He also looks at how can I actually use, for example, structured data, and how can I apply AI on that, and how can I help my customers? In that industry, it's not just about your internal, but it is also about providing information to your customers and then learning from that and benefiting and then thinking through, is there something where I can actually learn regarding my own way of doing better with the assets that I have? So a Forex and interest rate hedging strategy, including derivatives, those are aspects when, if you're really good, you can actually generate additional value. So altogether, there is not a single thing, I guess, this guy will leave untouched. And the idea is actually protect shareholder economic value against market variances with applying the best practices and the best knowledge possible. And so clearly there will be restraints from accounting side, but he will actually try to really be the best possible. And he's done that at Swiss Re, and good news, he's now working for us. When you look at the risk partnerships, then you can also see that there is an opportunity here which we believe will generate a lot more fee income, and where the capacity by 26 will go up by 50%. So one thing which they've already decided to do is that they actually will not so much go into net cat, for example, and where they actually think through how can we do business with other partners, and where do we actually not want to compete anymore? Where do we not want to allocate our risk capital to generate fees? And can we be smarter? And if we do that, then maybe we are not the best, but we find opportunities with players which we believe are better positioned than they are. So there is maybe also something to be said that they say we are not the best everywhere, but we can actually, through our partner network, make more money by actually being kind of opportunistic, looking at opportunities in the industry which we have not tapped into. So that's something which I feel is also recognizing that maybe others that you can partner with can do a better job and offer opportunities for you. Now, when I look at what the opportunity ahead of us is and what we can actually see, the visibility based on where we think this is going, then I think even if you just look at the current valuation, the PE is a good reference here of 5.8 times compared to a Swiss Re, Hanover Re, or Munich Re. I think leaves room also for a bit of multiple expansion. And I think we'd already be happy if we would work our way towards maybe 7.5 or 8 this year. And then looking at further expansion opportunity going into the next years. All that is supported with a very nice dividend yield. So you get paid to wait until this cultural change really works out. We think the kitchen sinking has already happened. And clearly we consider that valuation to be very tempting. This is why I'm actually giving you that insight or sharing our view about SCOR here. And I hope that you can understand our view on this, and that clearly the key aspect for us is that this probably was a kind of undermanaged business, which management that isn't so ambitious can actually have still be in business, and they will do well for themselves. But if you're actually more ambitious, you can take that up to the level of the best in class. And clearly, Thierry Léger is ambitious, and he wants to move up to the best in class. So over time, if we're patient, we could see that they could probably go up even to a PE of 10 if you think about the next 5 years. Because why not, if he performs so well, be kind of in line valuation with these other players? And by the way, that entire industry is actually not very expensive. So we actually have embraced insurance as such, and we consider it to be a good place, especially if you look at some of the valuations that you have elsewhere. Now, to summarize the bullet points, when you look at only a handful of reinsurers that can offer all that across all geographies, and when you are taking on reinsurance, then you think through, you won't have all that to be sitting with just one reinsurer. You go across a couple of those. This is why we believe that SCOR will be participating in that, and they can grow into it. This culture change, making it leaner, saving, and being more alert about which risk you take and how you partner, already led to a reduction in management layers from 10 to 6, and to a much more entrepreneurial spirit, which we have confirmed by talking to employees in the company and not just taking management for granted. SCOR is well capitalized to grow in the attractively priced property and casualty market, and the Life Re will develop into a stable profit contributor thanks to the accounting change of IFRS 17. We think that the valuation is attractive, and it is actually coupled with a rising dividend, which already is offering a nice yield. So when we look at an optimistic scenario, we could well see that these guys will outgrow the market, and they will benefit from their tier 1 status, and they will benefit of reinsurance clients actually going across the entire spectrum of top reinsurers to manage their counterparty risk. This is really our case in those bullet points. I hope you enjoyed that bit, and of course I want to share with you how we actually do that in our mandates. And here is our Frankfurter Modern Value ETF, where we have 25 of those wonderful businesses, which we have basically allocated to in 4%, so 25 stocks each. We are always fully invested. You see the Bloomberg here. It's basically based on an index, and clearly we built an ETF on it. We've been now going for a couple of years, and those companies which we do embrace here, you see that we do have some insurance exposure. We really like Storebrand in the Nordics as well, not just SCOR in France. We also have Munich Re, which we feel is undervalued for what it is and for the opportunity it offers. And Allianz already has done well, but we think it will continue to do well. And in the Netherlands, we've identified ASR. So you see that we do have an insurance bias because it's just very appealing, but we also have a lot of other wonderful businesses, but we have less of a bias of the Magnificent Seven and those classical ones. We still have some exposure, as you can see, but we do think we are actually, there's much more appeal now, valuation-wise, elsewhere. Now, how have we done? We started that index now good 3.5 years ago, and you can see we've done roughly, we've achieved 13% per annum. Once it was investable from the time, it is now up 43%, which is in line with what we expect. So if we get double-digit returns going forward, we would be delighted. That's what we strive for. Now, our whole spectrum of what we do is clearly we come from small and mid-cap. Formerly as a stock club, we were looking at microcaps too. Our heart's still beating for that, but we've progressed since then. Our balanced funds are much more to the appeal of the risk-averse investors, but we also wanted to offer those that actually really like exposure, fully invested, unhedged, no currency hedge either. We really thought this is something which we like. Maybe someone else likes it too. This is why we did our Modern Value ETF. And we look at catering to certain risk needs of our investors, and this is why we also have the balanced mandates. But the primary goal is to generate long-term wealth and do that with lower volatility compared to the stock market. We do have that cultural preference, which leads us to look at owner or family management companies because typically there it's better. Not only there, but there in many cases. And yes, we do look at ESG criteria, even though that's currently out of favor. And that, by the way, offers also opportunities again. We use Sustainalytics for that, and we exclude sectors where we say, you know, this is something which we just don't want to do. Gambling, porn, for example. There is aspects where we say we don't have to invest there, and we just don't. We have been doing this, me personally, for a good 40 years now. We are an owner-managed fund advisor, and we have, over those decades, quite some experience in the market. I have a lot of colleagues which would really like you to get in touch with them and explain more in depth what we're doing. And of course, you find us on social media. You can subscribe to it. A lot of information, unfortunately, is in German. But you know, there is DeepL and other stuff where you can translate it in case you want to just reach out to us in case you're interested. And unfortunately, I don't know whether Trump will be successful and we'll have peace and a great rally, or whether he'll attack, first swallow White Russia and then go on to Poland. So there's always a risk, unfortunately. Always take it with a grain of salt. Unfortunately, the future is uncertain. But I think I've presented you with a quite compelling opportunity. If you think about taking risk, you might actually think about doing it with SCOR. And here I leave those 5 bullet points and hope I'll have a couple more questions.
Wonderful. Thank you so much, Frank, for this presentation and the compelling investment case on SCOR. I'm wondering if you could elaborate a little bit on how you see capital allocation going forward, the mix there, and also what we could expect in terms of the dividend potentially going up over time.
Yeah, I think the key aspect is that think Thierry Léger realized that the risk-taking wasn't at the level that he expected it to be. And so, especially in the life re, he decided to change that. Now, I think that with the changes he's already made, we're probably somewhere in the 30 to 40% to where he wants to be. I think there we will actually see a really good opportunity to, in the future, taking risk there with much better returns. So there's a bit of a transformation and improvement that will happen over time. Where they're already much better, I think, is in the property and casual market. And here we think this is the opportunity that is actually already, it presents itself right away. So there will be less of a transformation required. And here I think he will be doing very, very well. And this is what will drive the opportunity for increased dividends. I mean, as long as the solvency ratio, which we currently see is not at risk at all, is good, then we see that, unfortunately, this is the thing here, they can't reinvest all the money because they don't need all that equity to generate higher returns. So they can share that with us with a higher dividend or even with a buyback. So I think it will go up clearly because we believe the profits will go up. And since they will go up, and yes, they will also be helped through this wonderful French deferred tax asset, which by repatriating profits to France will ensure that we'll also get some support of growing earnings from the tax guys. Now, identifying all these opportunities means that we're really getting a wonderful business, which it is in the making, at kind of Graham style valuation. And I find that to be really the case, which is like, you get a great business, but you actually don't pay up for it. And yes, there is some execution risk because the guy is not Superman. He will need support from management. But as you know, cutting out the management layers and bringing a new talent, he's absolutely relentlessly focused on making SCOR much more entrepreneurial. And at the Capital Markets Day, he already said, you know what, actually, I thought I have to have this management hat on for life and health until the middle of 25. Looks like I already have someone that could join maybe in Jan. So I hope he can actually announce that shortly and then have some talent running that, and he can focus on other aspects and being with his energy, driving this to even more success in the future. And so I see growing earnings and dividend through all his initiatives. And I do think that since it has been an undermanaged asset, there will be other elements which might open up opportunities. There might also be the odd one where you say, okay, he has to do additional cleanup, which might hold us back from being even higher growing in earnings. Because when you actually dig up everything, then you do find things, as we learned with life and health. So that is the risk side of it. But he's made very clear that he feels quite comfortable going forward with saying, the worst is behind us. And that's what gives me the comfort that he is very confident on delivering growing earnings in the near future.
And what would you see as the longer term risks to a reinsurance business such as this one?
Well, clearly the real risk that you really have is that you're not a disciplined risk taker. So currently the markets are quite firm, and I believe the fires that we're seeing in LA, or that we've just seen, they're kind of supportive, even though that risk doesn't really sit with these guys here. It sits with these first insurers, prime insurers. They actually are taking that risk, and maybe they have outplaced some of it to the likes of Lloyd's London, etc. I don't see SCOR or Munich Re being majorly involved there, but clearly taking those risks and also then having soft markets, because maybe climate change is actually delayed, which I don't think it is the case, and there's less risk, and so you have soft markets, and you can't really get the right prices, then that would impact the earnings going forward. Currently, you were benefiting from the last couple of years very, very firm markets, but there is a risk here that going forward, the earnings will be less because the markets turn soft. And we've seen that there's been a big cleanup in the market, but in the past, we've seen that sometimes when the markets are so appealing, you find others that offer to take on risk for silly prices, like some Bermuda hedge funds to step in and think they can actually compete, and they do compete. They take crazy risks, and most of them are kind of wiped out now. But you've seen that when the industry for too long a time is actually too high returns, it attracts other sources of capital, and that is always a risk here. And of course, that you do not have the discipline and management to not take the risk if it's not attractively priced. Now, Thierry Léger being head of risk, I don't think he is going to fall into that trap, but that means we could actually see some volatility in earnings, because if you don't take any risk, or less so, then your earnings will be less, but at least you don't get punished for taking risk which isn't priced correctly. This is what we really like about Warren Buffett and all his talents in the reinsurance market. That's something which they're very good at, but that also means if this is something that you do as a listed company, it shows up. And that it means maybe there's a bit of volatility in the stock price, and that could happen.
And how does inflation affect a business like this one?
Yeah, the inflation side is something which I feel quite comfortable with, because you can typically, when you look at pricing risk, you can typically price it according to it. But of course, in the past, you've taken on some risk, and then you have to think through if it's going into hyperinflation, that doesn't really go well. If it's moderate, it's okay. But if you go into hyperinflation, which is not my base case, then things become much more difficult, because then you just can't adjust as quickly. So an Amazon, which basically can adjust prices every second, or a Visa, is much better protected than a business like that in extreme scenarios. But if we look at moderate, which is my base case, we should do okay.
Very helpful, thank you. So what would be the key milestones or data points to keep an eye on going forward to gauge how the thesis is playing out?
Well, clearly, if you really want to see, is this guy really going to turn back the cash by rising dividends, you want to look at the Solvency II ratio, if that is within the guidance that they give. And if that is not impacted by some adverse issues, then that should be the case. And then you will actually see that the expected growing earnings come through. And clearly, you have to look into, are the markets, and there is brokers for the reinsurance market that you can look into, where basically they tell you how the business is going, whether the markets are firm or whether they're softening up. This is what you need to follow to feel comfortable being in that industry. Now, going into 25, that still looks really nice, and that gives me the comfort that the earnings quality is there, and that the growing earnings that we expect for the entire industry for this year will not be impacted at all. And of course, here with SCOR, that cultural change will add additional levers, and then of course the multiple expansion. And if that all works out, then I think the market will warm up to that cultural change, leading to a better view regarding, is this really a good company or not? Because currently, I think they are still through past management not being so well respected. They are more like the managers that just took care of themselves, kind of empire building guys, which are not really that hardworking and which were not so focused on always doing the right stuff. Now, that industry is kind of forgiving. If you just do an okay job, you will also do okay. But we're not happy just to do okay. We want to do well. Now, Thierry Léger is one of these guys that just wants to do well. So if he moves on, that would also be a risk, a key risk for us, making sure that he stays on, which he is committed to do. And he really is enjoying himself. He is very ambitious, and he just likes to build a team of people that are more entrepreneurial. And so I think that is not at risk. But clearly, maybe someone has an eye on him and wants to hire him away. So I would worry about that risk as well, and look whether that team is stable and will continue to enjoy themselves delivering those returns for us going forward.
Wonderful. Well, I will leave it there, Frank. I would just encourage MOI Global members to feel free to follow up with any further thoughts or questions. Once again, thank you so much, as always, for taking the time to join us and share your wisdom as well as this specific idea with our members.
Thank you very much for the opportunity. And clearly, I am talking my own book. I showed you in our ETF, the Frankfurt Modern Value ETF. So I don't want to take any blame for that. You know, this is my own book, but I do believe fundamentally that this is a good idea, and I hope it will work out for you. And I also believe that our Stadium, which didn't work out last year, going forward, that might offer also a good opportunity. Thank you for all your attention, and good luck with your investments and yeah, with the participation. And I hope there's going to be lots of other ideas waiting for you.
Thank you, Frank. All the best and goodbye for now.
Thank you. Bye-bye.